Welcome to the Power Market Report. I'm Albert Liu. U.S. stocks surged upward this morning after Bernie Sanders dropped out of the presidential race. The Dow added 600 points in early day trading, yet still many problems remain. Joining me once again is Mike Larson, senior analyst at Weiss Ratings. Mike, thanks for joining me. How are you doing?
I'm doing well. How about yourself?
Crazy, getting used to it as we talk, getting used to working at home, getting used to these crazy whipsaw reversals in the market. Here we are, I guess it's Wednesday, and we've had a pretty crazy Monday and Tuesday so far.
Yeah, absolutely. I mean, we've seen a little bit of a swing from Monday and then through late afternoon on Tuesday. We had a real swing from pessimism to optimism, disparity, euphoria, kind of whatever terms or metaphor you want to use. We had a big swing there, and I think some of the hope is that, okay, maybe in a few of these markets, New York City and so on, we've seen the sort of trend of this virus outbreak start to plateau and what have you. And I think that some of that has been clearly driving what's going on, whether it's stocks, whether it's bonds and so on. Multiple markets are being driven in the short term by that consensus there. And I would love to see encouraging news on that front. I think we all would. I think there are some tentative glimmers here and there, particularly in what's happening in some overseas markets. But as we've discussed prior to this, the virus and the outbreak has been the catalyst for a very sharp short-term downturn in the economy, for a lot of the short-term turmoil we've seen in the markets, and so on. But really, a lot of the risk that's out there has been building for quite some time, what I call embedded financial stability risk. A lot of risk being taken in the corporate bond market, for example, a lot of valuation excesses, and so on. So the market entered this period in a sort of hidden, vulnerable state, and I think that's part of the reason that the sell-off has been so sharp, not just the news driving it, but the fact that the market wasn't in a very good place from an internal standpoint before we hit this air pocket. So I think that's an issue, and those issues are going to linger even if we can and do get past the worst of this outbreak news.
You know, I think one of the things that the markets were perhaps cheering is the fact that maybe there is an end in sight, and they're looking to Europe for that indication. So as we hit sort of peak pessimism, it helps to be able to look at Europe and see maybe that there is light at the end of the tunnel. However, I saw a report this morning that said that folks in Wuhan are just now starting to get back to normal in the sense that they're being allowed to leave the city. So that was, I think it was 11 weeks of complete lockdown. Which gives you an idea of how long actually this thing could linger. So it's not going to be a step function back to business as usual. We're probably going to be going through a process the same way we went into this, with incremental releases of conservatism and gradually getting back to business. And I'm wondering, because of your relationship there, your position at Weiss Ratings, are you guys looking at what long-term impairments some of these companies are going to be having to deal with as we go forward? And this could take, 12 weeks. Who knows how long?
Sure. Well, for many, many years, dating back to the early 1990s, my firm, in addition to issuing investment ratings on stocks and ETFs and so on, also has done safety ratings, bank safety ratings, insurance safety ratings, and credit union ratings, and so on. And so we've got those two other business lines out there. And so I clearly follow the trends and what the data has been showing. And if there's one good thing, it's that from the sort of core regulated banking side of the business, we did enter this period of turmoil with a banking system that was in fairly good shape. And a lot of that's because of all the tight restrictions, all the issues and other things the government put in place after the great financial crisis. The problem is a lot of those risks, while some of them migrated off of bank balance sheets, they didn't go away. They migrated to non-bank lenders, to sort of hedge fund and other structured credit type platforms. And so there's a lot of this embedded risk taking that's been going on that you're seeing these non-bank lenders really get disrupted. If you've been following the financial news, you've seen, for example, some of the mortgage REIT companies basically begging for their version of a bailout. We've seen a lot of the junk bond exposed firms asking for a bailout there too, rather than just have the Fed buy investment grade corporate debt. So there's a lot of things going on off bank balance sheets that is not captured as much in things like the call reports that banks file, but is certainly out there and lingering. And the BIS has been talking about this, the IMF, some of these other multinational organizations have warned about it. And now we have the catalyst that's making all those background problems come to the foreground. And the one other thing I've seen in terms of what the ratings data shows me is that really dating back all the way to the beginning of 2018, the first quarter of 2018, we've seen a deterioration in the breadth and the ratings trends in our data. Our model, again, we rate every stock that trades in the US and Canadian markets. So we have a very broad-based ratings model. We run against the data every day. And what was interesting is the buy to sell ratio, the ratio of stocks we rated buy versus sell, is a great way to kind of see if the underlying breadth and participation in the market is expanding along with market rallies or if it's decreasing as the market goes higher. And what we saw is up until the first quarter of 2018, higher highs in things like the S&P 500 were confirmed. There was breadth behind the market, but it started to lag from that point forward. We saw slightly lower highs and lower lows in the buy-sell ratio at every successive S&P 500 peak since then. And I think you've also seen that in sector data, right? I mean, even before this virus stuff happened, we saw things like small caps lagging. We saw financials lagging, transports, and so on. So the market was losing some of its participation behind the scenes, which again goes back to my point earlier. The virus outbreak and the very intense impact it's having on the economy, on people's paychecks, on corporations and so on, was the catalyst. But there was a lot of market weakness behind the scenes already, and it's just been sort of brought to the forefront as a result of what's happening here.
Mike, one thing that you and I have spoken about in the past and agreed upon on the past, say for the past 2 years at least, is that the market is due for a turn and one should participate, but should participate carefully. And I don't know if you saw the memo by Howard Marks from Oaktree, but he sort of echoed that exact sentiment. That's what he's been doing for a while. And now he's starting to turn around. And so in the latest memo, he says, quote, not buying anything at the new low prices would be a mistake. And he says, he goes on to say, the most important job is to strike the appropriate balance between offense and defense. These things told me that the world was risky, low return place. And for that reason, Oaktree's mantra has been move forward, but move forward with caution. Now he's starting to change. And I think that is the correct way to look at the market now is not where you should go, but whether or not you feel it's time to play offense or it's time to play defense. What do you need to see to convince you that it is actually the time to start playing offense?
Sure. You're absolutely right that if you look at the trends up until sort of this January of this year and February of this year before the virus sell-off struck, it was clearly the defensive sectors that were winning the performance race. Your utilities, your REITs, your consumer staples were doing very well. Your transports, your industrials, your financials, and other offensive sectors were dramatically underperforming. We've seen in the last week or two or three as the Fed stepped in, as we've seen some of this fiscal stimulus, we've seen a little bit more of a mixed pattern. Some of those beaten down sectors have started to rally a little bit more. What I'm kind of waiting for is for this initial post-shock period to settle out. If we go back to the last couple of bear markets, you saw there were initial very sharp, very short declines. Catalysts were completely different. Of course, this time it's a virus. In the early 2000s, it was because we were starting to see tech stocks and IPOs blow up. And then in the mid 2000s, it was what was happening in the housing and mortgage sector. But after those initial sharp sell-offs, you did have very sharp bear market rallies that put on a lot of points in a short period of time. But ultimately that momentum faded and we started to roll back over. What I'm waiting for is in this bounce back rally that we've had, are we seeing momentum start to fade? It happened on Tuesday. We were up 900 something points in the Dow. We ended up finishing, giving up all that and then a little bit more. We're having a strong day on Wednesday, but is that going to persist? What I want to see is on the next sort of stall out of this bounce, how does the market behave? Does it just stall and hold its ground and those offensives continue to show a little bit more progress? Or do we start to get that sort of bear market pattern of the sharp rally rolling over? I want to see the character of the market after that happens before getting any more aggressive. The Safe Money Report is extremely defensive. A few things like gold and silver ETFs, treasury ETFs, a handful, one or two stock type names, and that's it. And that compares to several months ago being very overloaded in defensive stocks, and several months before that being overloaded in offensive stocks. So it's extremely low equity exposure. And I think that for many investors, we definitely want to wait, pause. Don't try and be, I guess I would call it, don't try and be a hero here with your investments. Be cautious, be conservative, see the character of the next phase of this, and then make a judgment. If we get close to a retest where there is fading selling pressure and then the markets turn around again, maybe that's a time to buy. If we just get a sort of stalling out as opposed to a rolling over and retest, maybe that's a sign that the next few months are going to be a good time to be long equities. But I think that, again, longer term, I'm very concerned that the cycle has turned. It was turning anyway before the virus struck. And a lot of the excesses of the multi-year near record bull market and economic expansion are still going to need to be wrung out. That's what we've seen in the last couple of cycles. We built up a lot of excesses in housing. We built up a lot of excesses in the tech arena. And it took, if you go back to the early 2000s, it took from 2000 all the way to early 2003 before the market bottomed. And the last cycle, the market topped in 2007 and late 2007. It didn't bottom till March 2009. So it was a long process in time, not just in price. And that's the real issue that I think we have to keep in mind here as well.
Those are very good sort of qualitative things to look for. Are there quantitative things you look for as well? Mr. Marks mentions that he looks at high yield now, if you exclude energy, of course. The yields have gone from 3.5% to 9%. Securities prices obviously have declined quite a bit. Maybe more to go, I think. But is there anything that you look for in terms of yields or in terms of earnings ratios that sort of help you in your calculation?
It's not a set situation where if I hit X basis points on a certain credit spread or X basis points on a certain yield instrument, that's sort of an all-in or even a strong buy signal for me. I'm more qualitative in the way I look at the market, especially in this kind of environment. I would say that I think if you look at the severity of things like unemployment, things like GDP change, things that we're going to see on the economic front as some of that lag data begins to be released, this is on a much greater magnitude than we saw in either of the last two downturns. I mean, the recession of the early 2000s from an economic standpoint was fairly shallow, and yet the S&P 500 lost 50%. The economic downturn in the great financial crisis was much greater than that, but in that cycle we ended up with a 57% decline in the S&P 500. Here, from sort of the recent peaks to recent trough, we're still talking 25-ish%, 30%, somewhere in that ballpark. It's happened very quickly, which is different from the last couple of cycles, but it still suggests if you're going to have worse underlying economic fundamentals, worse news on the earnings front, and a lot of excesses right up into the point where this thing struck, it's kind of hard to see the market bottoming and then just running back higher to old highs after only, and I put that in quotes, a 25-30% decline in the S&P. It wouldn't fit with the pattern of the last couple of cycles. So that's kind of how my big picture outlook there, and I might miss, let's say if we do stabilize, I mean, obviously we're up 15 some odd percent off the lows. If we do stabilize for a while and begin to keep going up from there, I might miss a few percentage points on the upside. But at the same time, I think the risk of further sort of that rolling over type pattern is pretty great here. So I'd rather just, again, be conservative. Don't try and be a hero. I mean, very short-term traders can play those kinds of bounces and sell-offs and so on. But from a longer-term perspective, I'm very hesitant to do aggressive bottom fishing, maybe a little bit of picking here and there, I guess is how I would describe it.
As we move forward and things start to become more clear, my personal concern for me and my clients is missing out on the rally that eventually will come. I'm not there yet, but that's top of my mind. Are you more concerned about losing more or missing out on a big move up?
I'm frankly still more concerned about losing more. If I were to look at the bounce we've had off the lows and say, okay, this is it, the bottom's in again, this is going to be like, say, December 2018, where if you bought into the Powell pivot back then, you rallied right back to highs a few months later and then kept on going. I would find that kind of scenario extremely unlikely here, and sort of the risk of being left behind, therefore, a lot lower than the risk of, hey, I'm going to commit a bunch of capital here, and then we're going to roll over and add another 10 percentage points of downside below the lows we just hit a few weeks ago. That's my greater concern at this point, again, because it tends to fit those end of cycle patterns. And I think that, if you go back to the past couple of bear cycles, you always have these shock events where you get sharp short-term declines. People sort of catch their breath, things stabilize, you get those counter trend rallies, but then you hit the more grinding phase of the downturn. I mean, that's what it really comes down to. Are we going to see that resumption of selling in a more gradual but lasting, persistent pattern? And that's what I think, again, before getting aggressive with committing capital, you want to see the character of this bounce. What happens over the next few weeks? Does the bounce run out of steam? Do we start that grind phase of this or not? And if we don't, then yes, I would get more aggressive. But I think I'd rather sort of sit on my hands here and wait for a little bit more confirmation, because I think the risk of lower lows is probably greater at this point.
Very good, Mike. Thanks for the great update. Good to talk to you. Let's do it again soon.
Great. Thank you.